Welcome back. In this lecture, I'm going to start to take an in-depth look at different types of investments. Although there are literally thousands of different financial products for you to invest in, most of them are made up of the same basic few types of financial instruments. So you can consider this lecture, and the next three that follow, your introduction to the main building blocks of investments. Later in the course, I'll also introduce a few more building blocks that you might want to add to your set. But the ones that I'll show you now are what I consider the essentials. And the investment I want to start with is stocks. Now, this may come as a big surprise to you. After all, stocks can be pretty risky investments. So, isn't starting to invest by picking stocks like learning to swim by jumping into the deep end of the swimming pool? Absolutely. So let me be very clear that I'm not saying that stocks are the investments you should buy first. But I am convinced that stocks are the best place to start learning about investing. And there are several reasons why I say this. First, the basic ideas behind stock investing are clear and easy to understand. The ideas behind stock investing are really the same ideas behind all the investing we do. Also, the stock contract itself is very simple. Other investment contracts are more complex, and sometimes those details get in the way of understanding the big picture. And finally, the details of stock investing, the nuts and bolts of buying and selling stocks, should you ever want to do that, are very similar to the details of other types of investing as well. So although stocks are not necessarily the best starter investment, they are a great model for learning about individual investments and how to use them. The way to start thinking about stocks is to think about what companies do and why they need stocks to achieve their goals. Every day, the media is full of reports about companies who have just announced bold new projects. For example, in August of 2011, Google announced that it had made a deal to buy Motorola Mobility. This was a surprising deal. Google is a provider of internet services and software, and Motorola Mobility was primarily a maker of mobile phones. And even though Google produces the operating system that makes mobile phones work, this is still a risky combination of businesses. It's an expensive deal, too. Google agreed to pay $12.5 billion. But it could pay off tremendously, making the money spent on the deal seem like a real bargain. This example shows what businesses are supposed to do. Try risky but innovative and surprising new projects that have the chance to create valuable products and handsome profits. These projects always involve investments in real assets. To make something new, businesses need to buy machines, factories, land, ideas, and in the case of Google and Motorola Mobility, entire companies. To do that, though, they need money. Lots of money. And chances are, businesses don't have enough cash on hand to fund all the projects they want to pursue. They have to borrow the money from somewhere. And this is where financial assets come in. Financial assets are documents that describe the terms of a loan. The borrower gets money now, and the lender receives something of value in return. Usually, the thing of value is a promise from the borrower to make cash payments in the future to whoever the holder of the document happens to be at the time. But there are other valuable things that a firm can offer in exchange for a lender's ready cash. One of them is an ownership stake in the business. There are several legal forms that this shared ownership can take, such as a partnership, but by far the most successful form of shared ownership has been the corporation, which uses stock. When a firm issues stock, it divides up the ownership of the company into thousands, if not millions of equal parts, which are the individual shares. Each share has an equal claim on the firm's profits and an equal say in the management of the firm. The more shares you buy, the bigger the slice of the company's profits you receive, and the more influence you have on company decisions. This is one of the reasons why I wanted to start with stocks. I think that all of us can understand and identify with, maybe even fantasize about, becoming the owner of a company. If you own a company, then your investment increases in value when you make good decisions and invest in successful projects that increase your company's profits. I'll have a lot more to say about picking stocks in future lectures, but the basic skill of stock investing really boils down to finding companies that invest in successful projects. That's true when it comes to picking other types of investments as well. Well, the story I've told so far about stocks is basically right, but it's highly stylized. I'm going to add a dose of reality now and try to explain how the stock contract tends to work in practice. This will help distinguish stocks from other financial instruments, and it'll give us a few tips along the way about stock investing. First off, the story I've told makes it sound like whenever a company has a good project it wants to fund, it just sells some shares to investors. In reality, companies don't sell shares all that often, and they don't fund most of their projects through selling shares. When a company sells shares to the public for the first time in a special sale called the initial public offering, or IPO, it usually does use investors' money to expand its business and start new projects. And when one company buys another one, it often pays for this purchase by issuing new shares. But otherwise, firms are reluctant to sell shares. There's a long and interesting explanation why, but the short version is that there are usually cheaper ways for firms to borrow other than selling shares of stock to investors. What this means is that most investors buy their stock from other investors, not directly from firms. By the way, we use the term primary market to describe the market for new assets that investors buy directly from the borrowers who issue them. So when Facebook has its IPO and sells shares directly to the public, this takes place in the primary market for stocks. We use the term secondary market to describe the market for used, or more accurately, pre-owned assets. When one investor buys a share of Citigroup stock from another investor, we say that this takes place in the secondary market for stocks. The primary and secondary markets aren't actually different markets or different places, just different types of transactions. So just because you're buying an investment in the secondary market, it doesn't mean that you're not really lending the company money. What you're effectively doing is taking over the loan from someone else. Your objective as an investor is still the same, whether you're buying in the primary or secondary market. Find those good companies that will make your investment increase in value. Another way that the real story of stocks differs significantly from the simple version is in terms of control. The simple story of stock investing makes it sound like corporate decisions are made in town hall meetings, where all the shareholders get together and have a chance to make their voice heard. The reality is that most investors hold such a small piece of the company that they have very little, if any, impact on its decisions. Corporations are a type of representative democracy in which shareholders elect a board of directors who represent their interests. But the board of directors then turns around and hires a professional management team, which runs the firm day to day. For large companies such as IBM or ExxonMobil, only shareholders who own millions of shares have the potential to affect the decisions of the firm, and even then it's fairly difficult for them to do that. Despite this reality, the power of ownership that goes along with stocks does still matter. If the managers of a company make a string of bad decisions that threaten the value of the shares, stockholders will start to put pressure on the firm to improve. You may have heard of so-called activist investors such as William Ackman or Carl Icahn, who amass large blocks of stock in poorly performing companies and then pressure the managers to change the way that they run their business. Because of activist investors and other mechanisms that I don't have time to get into, bad managers eventually get punished and their firms get reformed, while good managers eventually get rewarded and their firms get more valuable. So even though you probably can't exercise much control over a firm that you invest in, you can still benefit from the power of ownership by looking for companies that are run by good managers whose firms haven't yet been adequately rewarded. Yet another way that reality differs from the simple stories we tell about stocks has to do with dividends, which are the profits that companies pay out to their shareholders. While it's true that stockholders are entitled to a share of the company's profits, the company isn't under any obligation to actually pay them out. Many corporations, up to 40% or more according to some estimates, don't pay any dividends. There's actually a good reason for this, though. When a firm earns profits, it has a choice. It could pay the profits out to shareholders, or it could hold on to the profits and reinvest them into new projects. If the projects are really great and offer high returns, then shareholders should be glad to let the company keep the profits, reinvest them now, and pay out even more profits later. A company like Microsoft is a great example of this. For many years, Microsoft didn't pay any dividends to its shareholders, and its stock still rose like a rocket. That's because the market for personal computers was exploding, and Microsoft's sales of software were exploding right along with it. Microsoft had great investment opportunities in the form of new versions of its Windows operating system and its Office software, among many others. Investors were happy to let Microsoft hold on to its profits so that it could continue to invest in these projects. But eventually, Microsoft found that it was making more profits than it had good investments to spend them on. So it started to pay a small dividend in 2003, and it's been paying one ever since. The final reality of the stock contract that I want to mention is that if you buy a stock, you'll have to sell it sometime if you want to convert it to cash. A stock is technically a loan with infinite maturity, so the company won't ever actually pay back the loan. In reality, of course, most companies come to an end eventually, but there are some companies out there that have lasted for 100 years or more, like AT&T. And, as I just mentioned, a stock may not ever pay out any cash dividends at all, so you may not get any interest on the loan either. Why is it important that you have to sell your shares to cash out your stock investment? Well, combine this fact with one I mentioned a few minutes ago. Firms don't sell much stock directly to investors. You usually have to buy stock from someone else. Together, these two facts imply that trading is an essential part of investing in stocks. You may not trade very often, but you should know how to do it safely, and you should know what your options are in terms of trading services. Let's start to think about trading stocks by making clear what it is you're trading. Stocks, and all other financial instruments, used to be physical documents. Companies had special certificates made for their stocks, which often had designs on them that were as elaborate as the designs on money. When people traded stock, they actually had to physically deliver these certificates to each other in order to complete the sale. Well, needless to say, this can get a little cumbersome, and it isn't all that secure either. That's why stocks and other securities have been largely dematerialized over time. That's a fancy, almost science fiction-y term, but all it really means is that we keep track of stock ownership through electronic records rather than by possession of physical documents. Specialized financial institutions called depositories are the official storage places for most securities these days. The depository stores the shares electronically, keeps track of who owns the shares at all times, and effectively transfers ownership of shares when they change hands. It's an essential part of the financial market, but not one you hear about all that much. Stocks, like most financial assets, tend to trade in organized markets. Most investors who buy and sell securities like stocks will have to go through an intermediary, a middleman, if you pardon the gender bias there. And there are two types of intermediaries in the financial markets. How they differ and the way they earn a living is important to keep in mind. One type of intermediary is a broker. A broker simply helps buyers locate sellers, and vice versa, and arranges a sale. A broker may also help buyers and sellers agree on a price. The buyer or seller, or both, pay a fee or a commission to the broker for these services. One type of broker that most people have experience with is a realtor. A realtor helps bring buyers and sellers of homes or other properties together, facilitates the sale, and collects a commission for doing all that. Generally speaking, if you want to invest in individual stocks, you'll need to set up an account with a broker. A brokerage account operates a lot like an ordinary bank account, except that, in addition to cash, your account also contains the securities that you buy. When you buy stocks through a broker, technically the broker is registered as the owner of the shares in the securities depository. But the broker's internal accounts will show that you have a claim on your broker for those shares. This is done so that the shares can be transferred very quickly, and this practice is known as holding the shares in street. You don't have to worry about holding your shares this way with a reputable broker. Brokers have to comply with a lot of regulations that make sure that they can't misuse the customer's money and securities. And there is a fund, like the FDIC, that protects the value of your account if the brokerage firm goes bankrupt. It's called the SIPC, or Securities Investor Protection Corporation. You have lots of choices among brokers these days, but the main difference between brokers boils down to two questions. The first question is how much human contact you want from your broker. There are still lots of human brokers out there, and they'd be glad to take you on as a new client. On the other hand, there are online brokers that will let you do almost everything yourself at your convenience. And you can have some kind of mixture of the two. Keep in mind that human brokers can be great resources. Their knowledge and experience can go well beyond stocks into all areas of investing and financial planning. In fact, many brokers these days double as financial planners. But that human touch and the advice does come at a price. And brokers are people too, with their own biases and incentives. If you do choose to use a live person, make sure you know how the broker is earning money by working with you. Brokers earn fees by providing services, and they earn commissions from selling products. Good brokers will always be honest with you about what's in it for them when they offer you any advice or product. With online brokers, the big issue is how good their customer service and technical assistance are. Most online brokers will let you poke around their websites without having to open an account, and I strongly encourage you to do that before you settle on a particular online broker. Besides the amount of human contact you want, you also need to consider the amount of services you want from a broker. All brokers provide the basic services of maintaining your accounts and executing the trades that you pay them to make on your behalf. But some brokers provide additional services. For example, a full-service broker will give you investing advice, as well as access to the firm's own research on different companies and on different investment opportunities. And some brokers will give you access to online screening programs that search for stocks according to certain criteria that you specify, like stocks that pay high dividends. Before you sign up for extra services, though, you should take a good look at what's available for free. You may well find that for the type of investor you want to be, there's plenty of good data, analysis, and advice to be had for the price of your monthly internet service. Now let's talk about the other type of intermediary, the dealer. A dealer also connects buyers and sellers, but does so indirectly. That's because dealers are traders themselves. Dealers announce to the market that they will sell a specified security to anyone who is willing to pay the dealer's asking price. We call this price the ask price for short. At the same time, dealers also announce that they will buy this security from anyone who is willing to sell at the dealer's offering price. We call this one the bid price. So a dealer is always ready to sell to you at a price called the ask price or buy from you at a price called the bid price. This makes life convenient because you don't have to wait for a broker to find someone for you to trade with. You can go to a dealer and buy or sell immediately. Now, the dealer earns a living from this by setting the ask price, the price at which the dealer will sell a share of stock to you, higher than the bid price, which is the price that the dealer will buy a share of stock from you. So when the dealer buys a share of stock from someone and turns around and sells it to you, he or she earns the difference between the bid price and the ask price, which is called the bid-ask spread. Now, it may seem unfair at first that you have to pay a higher price to buy than you'd get from selling. But the fact of the matter is that when you buy or sell most financial instruments, you have to pay something. When you use a broker, you have to pay a commission. I will say, on the other hand, that commissions tend to be smaller than bid-ask spreads on the same security. That is, a broker charges less. But there's a good reason for that. A dealer takes on a lot more risk than a broker does. When you use a dealer to sell shares, the dealer pays you right away, but he or she may not be able to find a buyer for those shares very quickly. Well, that's the dealer's problem. When you use a broker to sell shares, you bear the risk of not being able to find a buyer as quickly as you want. In some financial markets, you'll mostly find dealers bringing buyers and sellers together, while in other markets, you'll find mostly brokers. But in the case of stock markets, there are lots of both. And not only are there both brokers and dealers, but many people wear both hats. That is, they're broker-dealers. Traditionally, brokers have been associated with stock exchanges, like the New York Stock Exchange. A stock exchange is an organized market where people can meet and trade shares. But they're not open to everyone. You have to be a member of the exchange in order to trade shares on the exchange. And to become a member, you have to pay a fee. A really big fee. The members of the exchange earn money not only by trading their own shares, but by trading shares on behalf of people who are willing to pay them a fee, a commission, for this service. And thus the members of stock exchanges become stock brokers. But not all stocks are traded on exchanges. Many stocks trade in a dealer market. Traditionally, this was called the over-the-counter or OTC market. Now it's usually referred to as NASDAQ, after the name of the electronic trading system for the OTC market that was introduced in the 1970s. For years, the stock market was roughly divided up into the exchanges on one side and NASDAQ on the other. Since the advent of the Internet, however, dozens of online trading systems have been created that compete with NASDAQ as well as the traditional exchanges. Now there's a large and frankly confusing array of stock markets, and almost any company's shares can be traded on any of these systems. Fortunately, though, stock trading has remained relatively simple and dependable for investors despite the increasingly complex stock market. This is mostly because you're paying your broker to handle the trading for you. In addition, the SEC requires trading systems to show each other their prices, and it requires brokers and dealers to send their customer's order to the market that has the best price that can be executed immediately. So when you submit an order through your broker, the broker has to find the best price for your shares. If that price is found on an exchange, then the broker trades on the exchange. If the best price is found in a dealer-dominated market like NASDAQ, the broker trades with one of those dealers on your behalf. In some cases, your broker will actually trade with you directly, acting in their capacity as a dealer. In the end, all you see is that your trade gets executed. Well, let's say you open an account with a broker, spend some time crunching numbers, reading up on companies, and you find a stock that really excites you. Before you plunge into your first or next stock investment, you need to know a few things about lot sizes and types of orders. First, there's lot size. We tend to buy things in standard quantities called lots. We buy eggs by the dozen, shoelaces by the pair, and copy paper by the ream. You could buy a single egg, a single shoelace, or a single piece of paper, but it's hard to do and more expensive. In the same way, financial instruments also have standardized lot sizes. For stocks, the size of a round lot is 100 shares. You'll get the best price and the fastest trade if you buy or sell in multiples of 100 shares. Now, I realize that this may put that stock investment out of reach, at least for now. After all, 100 shares of Google is about the price of a new car. But the higher price you'll pay per share for an odd lot makes it harder to profit from the shares. Why put yourself at a disadvantage like that right off the bat? Now let's turn to orders. We may think that stock trading is just a matter of hitting the buy or sell button on a trading screen, but there are several different types of orders you can submit to the market. Using the right language can help set conditions on your order that help protect you from adverse market movements. First, let's start with a market order. A market order is an order to buy or sell at whatever the current market price is. This is the type of order that most of us have in mind when we think of trading stocks. The basic problem with market orders is that market prices can move very, very quickly. You may have heard a friend complain, for example, that they hit the buy button when the price on the screen said $25, but they got a trade confirmation for buying 100 shares at $27 or $30 each. Electronic trading allows orders to be placed very quickly, but it also enables prices to move that much faster. You may have also heard about the infamous flash crash of 2010, when the Dow Jones lost 1,000 points in just over 10 minutes. That's an extreme example, of course, but it shows what kind of price changes are possible these days. You could protect yourself from nasty surprises like this by using a different type of order, the limit order. A limit order places an upper limit on the price you're willing to pay, or a lower limit on the price you're willing to receive. In the above example, if you submitted a limit order at $25 a share, you would ensure that you wouldn't end up paying any more than $25 for the shares, and you might actually end up paying less. Now, if the price moves up above your limit order, the order won't be filled. But limit orders are customarily valid for an entire trading day. So if you put in a limit order in the morning, the price may bounce down below your limit and enable you to buy at the price you want. Technically, what happens is that your limit order is entered into what is called a limit order book, which is maintained by the electronic trading system. The limit order book basically shows the demand and the supply curves for shares. And as an economist, I just had to mention that. Placing limit orders may mean that you don't end up buying or selling those shares. In addition, limit orders do cost more than market orders, so you should be aware of the cost difference and think about whether it's worth paying that extra money for the trade. But the protection that limit orders provide may well be worth the cost. One more order that you should know something about is the stop-loss order. A stop-loss order is an order to sell shares that is triggered once the price of the shares falls below a certain level. So if you set a stop-loss order for 100 shares of Verizon Wireless at $80 a share, the sell order is placed as soon as Verizon Wireless's price goes to $79.99 or less. Now, the problem with stop-loss orders is the same problem with market orders. Once the price goes below the stop-loss level and the order is submitted, the price can keep falling dramatically. Even though the stop-loss was set at $80, the order might not be filled before the price fell, say, to $71 a share. The point is that many traders think of stop-loss orders as a type of insurance, but it's not. If you think you need to use a stop-loss order, you should think carefully about where you should set the stop-loss level. You should probably also ask yourself why you're holding the stock in the first place. At this point, I think we've covered just about everything you need to know about stock investing, except which stocks to pick. We learned some key facts about how stocks actually work, and some of these ideas will help us later when we learn about stock pricing. We also learned a lot of important details about how stocks are traded. Well, I hope that this information about this introduction to stocks has helped you feel more comfortable with the idea of investing in stocks and other financial assets as well. As I said in the beginning of the lecture, I really don't expect you to want to start your investing career here. But I hope that at this point you're not ruling out the possibility that you might find a great company that you want to own a piece of. In future lectures, I'll be giving you a lot of information about how to find a great company or two. But in the next lecture, I'm going to go over the basics of another investment, bonds. See you then.